Okay, let's unpack this. In a healthcare landscape dominated by titans like United Health, can a tech-forward upstart like Oscar Health truly disrupt the system and build a lasting competitive moat? Or is it, destined to be just a niche player in a world of giants? That's the core question we're diving into for you today. Our mission is to dissect the source material we have, helping you understand whether Oscar represents a groundbreaking opportunity or perhaps a cautionary tale. We're talking about Oscar Health, Inc., traded on the NYSE under the ticker OSCR. Our analysis is anchored to June 19, 2025, when the closing share price was $14.95. And hey, for more in-depth analyses like this and to get priority deep dives on tickers chosen by members, you can like and subscribe to the stockanalytics.ai YouTube channel. Members paying €4.99 a month get exclusive priority. So definitely check that out and stick around, because what we uncover about Oscar's intrinsic value might just surprise you, despite some, well, very real risks looming on the horizon. We're going to kick things off by laying the groundwork, diving into Oscar's core business, the team at the helm, and what the financial numbers truly tell us. Chapter 1. Business Analysis. Deconstructing the digital insurer.
Right, so at its heart, Oscar Health is, yes, a health insurance company, but its DNA is fundamentally different. It was built from scratch as a technology company first. Think of it like this. Most legacy insurers operate on these kind of patchwork systems, right? Like adding new rooms to an old house. Oscar, though, they built their entire house, their full operation from the ground up, on a single, modern, integrated tech foundation. This full-stack technology platform is absolutely central to its business model. The goal, to simplify the incredibly complex world of health insurance for its members.
That full stack approach really sets them apart. So where does Oscar actually make its money? How does the revenue break down?
Well, their primary revenue, the lion's share, comes from premiums paid by members, those nearly $3.0 billion in Q1 2025 alone. Like other insurers, Oscar invests the float they hold from those premiums. That generated about $46.1 million in investment income in Q1 2025. But here's where their tech-first strategy pays off in another way. They have a small but strategically pretty significant services and other segment. It contributed $4.3 million in Q1. This comes from licensing their proprietary technology to other healthcare players. It shows their tech isn't just for internal efficiency, it's an external revenue stream too.
That B2B play with licensing sounds like a smart move. Diversifies things a bit. What exactly are they selling to consumers and businesses? What does their product portfolio look like?
Okay, so Oscar's product portfolio targets different segments. Their largest and most important line is individual and family plans. These are mainly sold through the Affordable Care Act, or ACA, marketplaces. They also offer small group plans for businesses and increasingly Medicare Advantage plans. But the Plus Oscar platform is really unique. This is their B2B service where they license their tech stack to others, things, regional health plans, provider systems. It helps these clients with, member engagement, care routing, administrative efficiency. They've basically productized their internal tech.
And how big are they in the market currently? Are they truly a challenger to those giants we mentioned?
Well, since they started back in 2012, Oscar has grown quite a bit. As of March 34, 2025, they served around 2.0 million members. That's a remarkable 41% increase year over year. So serious growth. They now operate in 18 states and hold about a 7% market share in that critical ACA marketplace. So yeah, they're a significant challenger in that specific space, but still, a smaller fish compared to the industry titans overall.
Got it. And what's their main pitch? How do they differentiate themselves from those traditional insurers who've been around forever?
Oscar's core mission is all about making health insurance simple, user-friendly, and affordable. They want to cut through the usual frustrations, confusing paperwork, opaque pricing. They deliver on this through a highly rated mobile app, which is kind of the central hub, telemedicine services, including virtual urgent care, dedicated concierge teams for personalized support, and transparent pricing tools. Even their branding, Hi, We're Oscar, reinforces this approachable, user-friendly image. It's quite different in an industry often seen as, well, anything but friendly.
That user-friendly angle definitely makes sense in such a complex industry. So what's the broader market looking like for them? Is it growing? Is the tide lifting their boat?
Oh, the market is enormous. The U.S. health and medical insurance market is estimated at $1.59 trillion in 2025, and it's projected to hit $2.13 trillion by 2030. That's a healthy 6% compound annual growth rate. So a huge growth backdrop for Oscar. Critically, several major trends play right into Oscar's strategy. You've got the rapid digital transformation and AI adoption in healthcare, the rise of consumerism, patients demanding more transparency and personalization, and a big focus on virtual care. All these trends inherently favor a tech-first approach like Oscar's.
So they've got tailwinds from market trends. That's good. But who are they really up against in this massive market? Who are the main competitors?
The competition is incredibly fierce. It comes from two main camps. First, the legacy behemoths of United Health Group, Humana, Cigna, Centene. These companies have immense scale, vast resources, deeply entrenched provider networks, decades of brand recognition. They are formidable. Then you have the new wave entrants. These are other tech-focused startups also trying to win over that digitally native consumer. So Oscar has to compete on tech and user experience with these new players while simultaneously battling the sheer price power and network depth of the giants. It's tough.
And healthcare is just notoriously regulated, right? What does that mean for Oscar's business model specifically?
Absolutely. The U.S. health insurance sector is one of the most heavily regulated industries. Federal and state laws create this really complex web. The Affordable Care Act, or ACA, is the primary framework for Oscar's business, since a huge chunk of their revenue comes from those ACA marketplace plans. And this leads directly to the single biggest regulatory risk they face: the potential non-renewal of enhanced advanced premium tax credits, the APTCs, at the end of 2025. If these federal subsidies aren't extended, one study suggests up to 7.2 million people could drop their ACA coverage. That would drastically shrink Oscar's core market. It's a huge potential hit.
Wow, yeah. That's a massive political and economic headwind hanging over them. What about the barriers to entry in this industry? Are they high enough to protect Oscar once they gain scale?
Extremely high. And this is what largely protects the incumbents and makes it so tough for new companies. Key barriers include just massive capital requirement for regulatory reserves, incredibly complex state and federal hurdles for licensing and compliance state by state, plus the monumental task of building broad provider networks, and the challenge of establishing brand trust against companies that people have known for generations. Oscar has overcome some of these, clearly, but they remain formidable challenges for anyone in this space.
Given all those challenges, the giants, the regulations, the barriers, what are Oscar's actual competitive advantages? What makes them stand out and, potentially win?
Well, despite being relatively young, Oscar has built a really strong modern brand. It's perceived as simple, tech-savvy. And this isn't just perception. Their Net Promoter Score, or NPS, is industry-leading at 66. The industry average is around 30. And get this, for their Spanish-speaking members, it's an even more impressive 87. That's a powerful indicator of customer loyalty in an industry people generally don't like.
That NPS difference is really striking. What else?
Second, cost advantages. While they don't have the sheer scale of United Health, they're showing a profound tech-driven cost advantage. Their Q1 2025 selling, general and administrative, or SG&A, ratio hit a record low of 15.8%, a huge driver of this. Their 98% AI-powered auto-adjudication of claims. That means almost all claims are processed without manual intervention. That's a structural cost advantage. It lets them scale without linearly increasing administrative overhead. It's fundamentally different from how legacy insurers often operate.
Okay, so brand and cost structure. Anything else?
Yeah, they also benefit from two types of network effects. First, within their insurance business, they build a curated provider network. As more members join, Oscar gains leverage with top providers, making their plans more attractive, which attracts even more members. It's a virtuous cycle. Second, and maybe even more powerful, the Plus Oscar platform creates high switching costs for its B2B clients. As more third-party health plans adopt their tech, it gets deeply embedded in their workflows. It becomes really difficult and costly for them to switch out. That creates a sticky, recurring revenue stream.
Makes sense.
But their single most important unique asset is that proprietary, full-stack technology platform. Because they built their whole operation on this single, modern foundation from day one. It enables rapid innovation, deep data integration, and superior operational efficiency. This isn't just about having cool tech. It's about using technology at every level to fundamentally change how health insurance operates.
Fascinating how their tech-first approach isn't just a gimmick, but a genuine differentiator that seems to be changing the cost structure. But no, a company is only as good as its leaders. So let's turn our attention to Chapter 2, Management Evaluation. Assessing the captains of the ship.
Right. Oscar's leadership team is a really interesting mix. You've got deep industry experience combined with that tech-driven vision. The most significant strategic move recently was appointing Mark Bertolini as CEO in April 2023. Bertolini, he's the former chairman and CEO of Aetna. He orchestrated its massive $69 billion acquisition by CVS. His arrival brought immediate credibility from the traditional healthcare world and, crucially, a laser focus on profitability. And we've seen that materialize dramatically in 2024 and Q1 2025.
Ah, okay. So bringing in the experienced hand, what happened to the founder?
Well, this transition also allowed co-founder Mario Schlosser to become president of technology. So he's focusing exclusively on Oscar's core differentiator, its platform. This structure puts a seasoned operator at the business helm, bringing discipline, while letting the visionary founder concentrate on innovation. It's a smart way to balance that narrative between innovative tech disruptor and stable, profitable insurance company.
That is a clever way to structure the leadership, especially given that pivot to profitability they needed. How transparent are they with their communication to investors and the market?
Very transparent, actually, which is usually a good sign. Their quarterly earnings releases are detailed. They provide clear guidance on key metrics. For example, in Q1 2025, they didn't just report strong results, they explicitly reaffirmed their full-year guidance. That signals management's conviction. CEO Mark Bertolini's public commentary consistently hits on growth, profitability, efficiency, and they have a standard, accessible investor relations portal. Pretty straightforward.
Okay. And what about how they're using their capital? Are they spending wisely to fuel this turnaround and growth? Where's the money going?
Yeah, their capital allocation is squarely focused on fueling growth and efficiency. Pretty typical for a company at this stage. They reinvest heavily in the business. That means continuously enhancing their tech AI tools, like virtual urgent care chat, Care Guide AI. They also fund market expansion into new states and develop new products, like their move into the ICHRA market individual coverage health reimbursement arrangements. That's a big potential growth area. Their strategy seems to prioritize capital-light strategic partnerships over big, costly acquisitions, which seems prudent for keeping financial flexibility.
Have they started returning capital to shareholders yet? Any buybacks or dividends?
No, not yet. As a growth stage company still focused on reinvesting for scale, Oscar Health hasn't paid a cash dividend or started a share buyback program. They prioritize putting all available capital back into the business to scale up and grab market share. It aligns perfectly with a high-growth strategy.
Makes sense at this stage. But what about their return on invested capital, that ROIC metric? Is that finally turning around with this new focus on profitability?
This is where the story gets really interesting, and it's a critical validation of management strategy. For most of his history, Oscar's ROIC was, frankly, terrible, deeply negative, reflecting all the heavy investment and losses needed to build the business. However, the trend shows a dramatic, pivotal turnaround. From a staggering negative 40.97% in 2022, it flipped positive to 4.18% in 2024, and then a powerful 11.54% in their trailing 12 months ending March 2025. This inflection point shows their substantial investments are finally generating profits that exceed their cost of capital. It's a clear signal their tech-first model is starting to pay off where it really counts.
The ROIC turnaround is certainly a compelling story, signaling real operational leverage is kicking in. But how does that translate to the cold hard numbers for you, the potential investor? Let's get into Chapter 3. Financial analysis, the story and the numbers.
Okay, let's look at the snapshot as of June 19th, 2025. Oscar's market cap is around $4.1 billion. Shares outstanding, about 254.7 million. Now, the PE ratio, trailing 12 months, it's quite high, around 67x. That reflects those high growth expectations we talked about. But looking forward, the forward PE is more modest, around 21x. Price to sales is about 0.47x. Debt to equity, you need to talk about that nuance. It's 0.22 if you just look at long-term debt. Current ratio, 0.91. And short interest is meaningful, around 12.0%.
Okay, let's start with revenue. You mentioned growth earlier.
Yeah, explosive is the right word. From just $590 million in 2020, it surged to over $9.1 billion in 2024. And it crossed the $10 billion mark in the trailing 12 months ending Q1 2025. This consistent high double-digit growth is really a core part of the bull case here.
Explosive indeed. But for years, that growth didn't come with profits. Has that finally changed? Are they actually making money now?
Yes, dramatically. This is the key story in their financials right now, the profitability reversal. In Q1 2025, Oscar reported an operating margin of 9.8% and a net profit margin of 9.0%. That's strong. On a trailing 12-month basis, their net profit margin has also turned positive to 1.22%. This achievement, getting into the black, seems to be a direct result of improving efficiency and the operating leverage they're getting from that tech model. They're finally translating growth to the bottom line.
So they're profitable on paper. What about free cash flow? Is the business actually generating real cash?
Good question. Free cash flow, or FCF, has historically been volatile for Oscar, often negative because they were investing so heavily. However, the recent trend shows a powerful swing to positive cash generation. In the trailing 12 months ending Q1 2025, they generated a strong $4.86 per share in FCF. That amounts to over $1 billion in total. This signals the business is becoming self-funding, generating significant excess cash. That's a very healthy sign for long-term sustainability.
It certainly sounds like they're finally turning the corner financially, but how consistent have their earnings been over time given this recent big shift? Is this a blip or a trend?
Well, you have to remember, for most of its history, Oscar's growth came with consistent losses. So no, they don't have a long track record of positive earnings consistency. However, the powerful positive trend is undeniable right now. Their diluted EPS went from negative in 2021, 2022, 2023 to a positive 10 cents in 2024, and then approximately 50 cents in the trailing 12 months ending Q1 2025. This positive inflection is what's really caught the market's attention.
Okay. And what about debt? You mentioned a nuance there. Insurance companies can sometimes have complex balance sheets that make debt ratios tricky.
Exactly. That's a crucial point of nuance for insurers like Oscar. At first glance, their headline debt-to-equity ratio might look scary high, like 3.37, but for an insurer, that's misleading. Most of what looks like debt isn't traditional loans, it's operational liabilities, things like benefits payable money set aside for future claims and risk adjustment transfer payable under ACA rules. When you isolate their actual long-term borrowing, it's much more manageable, around $300 million. That leads some providers to report that much lower debt-to-equity ratio of just 0.22. More importantly, Oscar holds a formidable $4.9 billion in cash and investments and maintains a $907 million excess capital position. That gives them immense financial flexibility.
Okay, that context is really important.
Yeah, and similarly, their current ratio of 0.91 might look low, but it's less concerning for an insurer because they have constant, predictable premium cash coming in. And just to reiterate, no dividends. They're still firmly in growth mode, reinvesting everything.
So how does all this translate to their valuation? Is the stock expensive now, or is there still potentially room to run for investors?
Given its recent profitability, yeah, Oscar trades at a high trailing PE ratio, roughly 67x. That number clearly reflects high growth expectations baked in. Its forward PE, however, is more modest at 21-23x. Now, when you compare this to mature peers like United Health Group at around 12.8x PE or Humana at 17.2x, Oscar is clearly valued by the market as a growth tech company, not a traditional slow-growth insurer. Interestingly, its price-to-sales ratio is actually more in line with peers. That suggests potential valuation upside if they keep expanding margins.
Okay, that covers relative valuation compared to others, but what about intrinsic value? What's the analysis suggest the business itself might be worth based on its future potential?
Right, intrinsic value. For that, we often use a discounted cash flow or DCF model. Think of it like valuing an apartment building. Its true value today is basically the sum of all the future rent checks you expect to get, but discounted back to today's dollars because money tomorrow is worth less than money today and there's risk involved. Same idea applies to Oscar. Its value is its future stream of free cash flows, discounted by an appropriate rate reflecting the risks.
Makes sense.
So based on an educational model, using consensus analyst growth projections, and a discount rate reflecting Oscar's specific risks, an intrinsic value can be estimated. External analyses using similar methods suggest a fair value for Oscar Health could be as high as $29.22 per share. Now, compare that to the current price, around $14.95. It suggests substantial potential upside if the company continues to execute its plan effectively.
That's a significant potential upside. What are the key assumptions driving that DCF model? What has to go right?
The key assumptions, the levers, include a revenue growth rate of about 12.5% CAGR for the next 3-5 years. That aligns with current analyst forecasts. We assume free cash flow margins will gradually increase to around 5% over time, reflecting that operating leverage from the tech platform kicking in. Critically, a higher than average discount rate of 10-12% is used. This reflects Oscar's specific risks, its reliance on the ACA, stock volatility, competition. Finally, a terminal growth rate of 2.5-3.0% assumes it eventually matures and grows more in line with the broader economy. That higher discount rate is important. It helps balance the optimistic growth assumptions, giving a more conservative estimate.
That's a powerful financial picture, emerging explosive growth, finally meeting profitability, and potentially significant intrinsic value, albeit with assumptions. Now let's zoom out. How is the market reacting to all this? Who's betting on Oscar, and what hurdles still lie ahead? Chapter 4, Market Sentiment, Gauging Mr. Market's Mood.
While Wall Street analysts covering Oscar Health are, broadly speaking, cautiously optimistic, The consensus rating leans towards hold.
Hmm.
But that average masks a really wide divergence of opinions. You see this in the price targets. They range from a low of $12 all the way up to 28 cents. The average target sits around $18.50 to $19.50. That suggests moderate upside from the current $14.95 price. But that wide range really reflects the significant uncertainty around that ACA subsidy risk we keep mentioning. Analysts are split on how big a threat that is.
How has the media been portraying Oscar recently? Is the narrative shifting with the improved financials?
The general tone in media coverage has definitely turned more positive lately,
Hmm.
mostly driven by the strong financial performance, especially that Q1 2025 earnings beat. Headlines often use bullish language, framing Oscar as a potential growth monster, highlighting its innovative use of AI. However, the more in-depth analytical articles almost always temper this optimism. They consistently point directly to the big political risk, that potential ACA subsidy expiration. So it's this clear tug-of-war in the market narrative. Strong operational performance versus a major external policy risk.
That makes sense. What does the short interest tell us? You mentioned it was around 12%. Is that high? Are investors betting heavily against them?
Yeah, short interest as a percentage of float is reported between 10.75% and 11.99%. That is a significant level. It indicates a meaningful group of sophisticated investors are betting the stock price will go down. Their reasoning: likely a combination of that ACA subsidy risk, the still high valuation compared to traditional insurers, and the intense competition. This sizable short position contributes to volatility. And, interestingly, it could fuel a short squeeze or rapid price increase if the company keeps delivering strong results or if positive regulatory news drops.
Right. The short squeeze potential is always there with high short interest. What about its price relative to its moving averages? How does it look from a technical perspective for investors watching charts?
Okay, technically speaking, as of our analysis date, Oscar's share price of $14.95 is trading above its 50-day simple moving average, which sits around $14.25. That generally signals positive short-term momentum, kind of an uptrend in the near term. However, the stock price is still slightly below its 200-day simple moving average, which is approximately $15.63. This suggests that while the short-term trend is positive, it's still recovering from a longer-term downturn. It's really at a critical technical point right now. A sustained move above that 200-day average would be a strong, long-term bullish signal for chart watchers.
Okay, so it sounds like the market is still making up its mind, kind of pulling in different directions. So who exactly is holding the cards here? Who owns the stock? Let's talk about Chapter 5. Ownership structure. Who owns Oscar?
Oscar Health's ownership is definitely dominated by professional money managers. Institutional ownership ranges somewhere between 61% and 74%. This includes the big passive index funds you'd expect, like Vanguard and BlackRock, but also significant holdings among active and early-stage investors, like Thrive Capital Management and Deerfield Management. Importantly, Thrive Capital, which is linked to co-founder Joshua Kushner, is actually the single largest shareholder. They control over 15% of the company.
Wow, over 15% is a big stake. What about insiders? Are the executives and founders holding a lot of stock themselves? And what have their recent transactions looked like? Any buying or selling?
Insider ownership is substantial, reported between 12.5% and 29%. That generally ensures strong alignment between management and shareholders' interests. Their skin is in the game. Now, there have been some disposition, non-open market transactions. These are usually tax-related sales, not necessarily bearish signals. But a really significant bullish signal came in late 2024. An entity associated with co-founder Joshua Kushner, Thrive Capital, acquired approximately $5.44 million worth of OSCR stock in an open market purchase. Buying shares on the open market like that's a very powerful indicator of confidence from those who know the company best.
Yeah, open market buys are always interesting. So the ownership is quite concentrated with Thrive Capital holding such a large stake. Is that generally a good thing or a potential risk for other investors?
It's kind of a double-edged sword. On one hand, it means the company has strong long-term backing from knowledgeable investors who deeply understand its strategy and potential. That can provide stability and good strategic guidance. On the other hand, it creates what's sometimes called an overhang risk. Venture capital funds like Thrive eventually need to liquidate their positions to return capital to their own investors. That's just how their business works. Because Thrive's position is so large, any future move by them to sell shares, even years down the line, could exert significant downward pressure on the stock price. That could happen regardless of Oscar's fundamental business performance, simply due to the large supply of shares hitting the market.
Right, the overhang risk.
That makes sense.
So the ownership structure reveals deep conviction, but also potential future challenges. And speaking of challenges, it's crucial we examine the full range of potential headwinds. So we'll now move to Chapter 6. Risk assessment. Identifying potential headwinds.
Okay, let's frame this using a SWOT analysis: strengths, weaknesses, opportunities, and threats. It's a good way to organize the risks. So Oscar's greatest strengths, as we've discussed, are its innovative, proprietary full-stack tech platform, that strong brand with high member satisfaction, NPS, the proven rapid growth, and its recent achievement of profitability driven by efficiency gains.
Got it. What about the flip side? Weaknesses.
For weaknesses, it still carries that long history of significant financial losses and cash burn from its early days. That history matters. Its geographic footprint is still limited compared to the national giants, and it has that heavy dependence on the politically sensitive ACA marketplace. Plus, like many growth companies, it's historically faced high customer acquisition costs, though maybe the tech helps there now.
Okay. And opportunities. Where's the future growth?
The opportunities look pretty good. Continued expansion into new states, massive growth potential in that ICHRA market, individual coverage health reimbursement arrangements, further scaling of the Plus Oscar B2B platform, and just the growing consumer demand generally for telehealth and digital-first healthcare solutions plays right into their core strengths.
All right, now the big one, threats. What keeps management and potentially investors up at night?
Now for the threats. There's the intense competition from legacy insurers with their vast resources and scale. That's constant. Cybersecurity risks are an ever-present concern in healthcare. A data breach would be devastating. But, as we've really emphasized, the single most acute threat, arguably an existential regulatory risk, is the potential non-renewal of those enhanced ACA subsidies after 2025. That could severely damage its core market by shrinking the pool of eligible members. It's the elephant in the room.
Definitely the big one. Beyond those internal and industry-specific factors, how do broader macroeconomic forces like inflation or interest rates, and even geopolitical stuff impact a company like Oscar?
Right. The macro environment presents kind of a mixed bag for Oscar. Inflation is a direct and significant threat, especially persistently high medical inflation projected at 7–8% in 2025. That directly increases Oscar's biggest expense, paying claims. If they can't raise premiums enough to offset this, profitability gets squeezed. Simple as that. Conversely, interest rates currently act as a tailwind. As an insurer, Oscar holds a big investment portfolio, $2.6 billion in long-term investments. Higher interest rates let them reinvest their premium float into higher-yielding assets. That boosts investment income, which flows straight to the bottom line. So the net impact really depends on the tug-of-war between medical inflation costs and higher investment income.
Okay, inflation hurts, rates help. What about geopolitical factors, like those tariffs mentioned?
Yeah, the U.S. imposed tariffs of 2025 are a more subtle but potentially potent threat. These include a 10% baseline tariff on almost all imported goods, but with steeper levies on critical healthcare inputs, things like active pharmaceutical ingredients for drugs, medical devices. Now, Oscar doesn't directly import these things, but the tariffs create a ripple effect. Hospitals and clinics in Oscar's network face higher costs for their supplies, and inevitably, those providers will seek higher reimbursement rates from insurers like Oscar to cover those costs. So it acts like a hidden driver of medical cost inflation, potentially eroding some of the cost advantages Oscar gains from its tech platform. It's an indirect hit.
That's a really interesting point about the tariffs acting as hidden inflation. Okay, that's a lot to consider, from the disruptive tech and turnaround story to the political and even geopolitical headwinds. And let's bring it all together for you, our listener, and synthesize the full picture. Chapter 7, Conclusion. Synthesizing the investment case.
Okay, summing up, the bull case for Oscar Health is pretty robust, built on several key points. First, it's a proven growth engine. They've shown an exceptional ability to attract members and grow revenue rapidly. Second, they've decisively achieved profitability. And importantly, it seems driven by real operating leverage from their tech platform, not just scale. Third, they offer a differentiated product. That superior user experience and high customer satisfaction, the high NPS, is genuinely rare in health insurance. Fourth, Oscar operates in a massive and expanding market, U.S. health insurance, with lots of runway for geographic expansion and new opportunities like ICHRA. And fifth, the Plus Oscar platform provides strategic optionality. It's a high-margin B2B business that also acts as a potential hedge against the political risks tied to their main ACA insurance business.
Okay, that's a compelling bull case. What about the bear arguments? What are the main reasons to be cautious?
Right. The bear case highlights significant challenges. Top of the list, that existential regulatory risk of the ACA subsidies expiring. It's a political event outside management's control that could severely damage their primary market. Cannot stress that enough. Second, they face intense competition from industry giants with vast resources and entrenched positions. They won't give up share easily. Third, there's valuation risk. The stock's current high trailing PE, multiple prices in a lot of future success already. There might not be much room for error. And fourth, those macroeconomic headwinds, especially medical inflation, could threaten their hard-won profitability if they can't manage costs or pass them through effectively. So it boils down to execution and that big political question mark. What about the valuation summary again?
Right. Our educational discounted cash flow analysis, which assumes they hit those growth estimates and sustain profitability, well, it suggests a potential intrinsic value for Oscar Health significantly higher than its current market price. This model, using that higher discount rate to account for all these risks we've discussed, aligns with external analyses placing the fair value somewhere in the range of $28 to $29 per share. Compare that to the current $14.95.
So what does this all mean? Investing in Oscar Health today, it really seems like a bet on two key things for you. First, that management continues its impressive operational execution, keeping up the growth and profitability. And second, that the political environment ultimately proves favorable, or at least not devastating, for the individual health insurance market, especially regarding those ACA subsidies. It's definitely a high-risk, high-reward proposition. It truly tests your tolerance for political and regulatory uncertainty. And this raises an important question for you to think about. In a world where technology is meant to simplify things, can any company truly escape the messy complexities of policy and politics, especially when it comes to something as fundamental, as personal as healthcare? Remember, members can add stock suggestions for future deep dives in the comments, and we will pick them up. So let us know what you want us to cover. And the usual heads up. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions. Thank you for diving deep with us on Oscar Health. We'll catch you on the next deep dive.